This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. It's the week ending January 16th, and here are a few of the highlights on the macro front. Fed Chair Powell is pushing back on White House pressure. JP Morgan Chase kicked off Q4 earnings season. December inflation brought a slight downside surprise. And new CRE projections for 2026 are coming out on a daily basis, mostly pointing to a positive outlook. Manus, what's your take on the week's market news?
Well, I had two words this week that were running through my mind, and they're very similar words to what we've been seeing for the last 6 months. When we're talking about the broader U.S. markets, I would call it meandering, and I will get into that in just a moment. When we're talking about the U.S. commercial markets, I would use words like confident or steady. So let's talk about the broader U.S. markets to start. The markets had plenty of reasons to rally this week, but really couldn't get out of first gear. Now, I say that with a little bit of hesitation. We're recording on the afternoon of Thursday, January 15th, and the markets are up today. We're seeing a rally today. But earlier in the week, we saw a little bit of choppiness, a little bit of sideways to down behavior. There was a lot of reasons, however, that the market could have gotten out of first gear. On the positive side, we saw a benign CPI report. We got nice bank earnings. Today, we got nice earnings from Morgan Stanley and Goldman Sachs. That seems to be driving some of the uptick today. We saw a modest dip in long-dated Treasury yields that provided some fodder for an early 2026 equity rally, perhaps. But we never really saw it because against that backdrop, we had geopolitical concerns, Iran, Greenland, activity in Minneapolis. We saw the potential for legal action against a sitting Fed chair. And we saw concerns that the AI trade might be stretched. Investors were saying cautious. So I would call the broader markets this week meandering, uncertain, directionless, perhaps, not sure what the next shoe to drop will be. In the U.S. commercial markets, as it's been for several months, the U.S. CRE market has been the calm, soothing grandmother to the hyper 4-year-old at a birthday party. Yes, there's wood to chop on multifamily and a whole forest to take down on office. But by and large, lenders and portfolio managers remain upbeat about the prospects for 2026. So for the U.S. commercial markets, at the opposite end of meandering comes confident, steady, upbeat.
I have to say, Manus, I really like that framing, the image of commercial real estate as this calm Grammy to some kid with a sugar high at a birthday party, because there is a lot happening on the macro side, and some of it's been very disturbing this week. And it kind of leaves you with this sideways, hesitant feel about the market. But I've been spending a lot of time this week reading the 2026 outlooks on commercial real estate from the likes of CBRE, Cushman Wakefield. And one consistent theme that I'm reading that I agree with is there's this general expectation of firmer fundamentals in commercial real estate, that 2025 was a year of pivoting, a year of getting more comfortable with pricing, a year of getting more progress on dealing with distressed assets. And there's a sense of ready and willing capital across commercial real estate. And CBRE is predicting, as I recall, a 16% increase in deal volume this year over last year. That seems reasonable to me.
I didn't go to CREFC this year, but in the past I would normally go. It's held every year, the second week in January. They throw a great conference, a couple thousand people head to Miami Beach and talk about the markets and so forth. So this I was getting a little bit secondhand since I didn't attend this year, but analysts were expecting a 30% uptick from 2025's already lofty levels in terms of CMBS issuance. And I think the narrative was consistently lending spigots are open. People are confident about lending. They see perhaps issuance on CMBS cracking the $150 billion level this year, which is extraordinary considering the fact that the last 2 years have already seen big surges in that market. that is a positive for those that are looking for either high levels of proceeds or cash to refinance tricky assets. All of that is great. Going from Miami to some of the headlines I saw this week that were consistent with that, these come from Green Street's Commercial Mortgage Alert, which comes out every Friday morning. Balance sheet lenders see a solid year ahead. That was one headline. And CRE CLO seers expecting near record 2026. So whether you talk about the confab that took place in Miami or the headlines coming out of, like you said, the brokerage research or Green Street, it seems to be all cylinders are functioning right now on the CRE market, at least as it comes to lending.
Agreed, but not in kind of an overheated, frothy way. That's kind of the sense that I got. The folks that I talked to that did go to CREFC said that the sentiment that they heard was the most positive that they've heard in all their years going to that conference. And in the bank earnings, no matter which bank you're looking at, whether it was JP Morgan Chase or Wells or Bank of America, there is an overall confidence that you just mentioned for higher borrower demand this year. Certainly the expectation of a steady stream of refi requests coming in, solid loan growth overall. A few mentioned that they're still concerned about office, which is totally understandable. I'm attending the Environmental Bankers Association conference in a few weeks, and as I pulled together my own market forecast for that, things that kind of stick out in my mind beyond what we've already talked about, and we're seeing this in LightBox's market metrics across the board too, is we're kind of emerging from this period of a major price correction. And the other thing that I think will affect our market in a big way this year is we have a lot of sectors now that aren't overbuilding anymore, and fundamentals in some sectors are in much better shape than they were a few years ago. So I think we'll see capital moving into those healthier sectors. We're going to see investors rebalancing their portfolios. We're already starting to see that. So, let's hear it for the calm, wise grandmother. I'll take it.
I have to give a shout out to Joe McBride. He was one of my co-hosts when I did my early podcast back at TREP. We probably did 150 podcasts together. And he since has been at Moody's and now he's at Citus. He put something on LinkedIn which was just hysterical. And this is a little bit of a sidebar, but he talked about the types of people that you see at CREFC, and it is a mirthful take on, and it's so spot on. He gives them all Latin names. He says 20% of the people there are determinus maximus, often returning stone-faced, walking briskly on a mission to write down every conversation from the day into the trusty Salesforce. If you're looking for a couple of laughs today, search out this rundown of what happened at CREFC. Hysterical about the parties, the vibe, the attendees, and so forth. And I just got a kick out of that. I thought it was terrific.
Dianne, let's pivot to the data dive. What do you have for us this week?
Well, Alyssa, last week we had just scratched the surface on our December transactions, and this week I have our final numbers. The biggest deals in commercial real estate that Manus's group tracks in December, these are the deals that are over $100 million, were up 44% in December over November. And the next size category down, these are the $50 to $100 million deals, were up even more by 47%. And guess what, Manus? December set a new high water mark for these big deals, coming in just a hair above a very active October. So I'll say, Manus, I have to give major props to your data collection team for getting these data sets to me at the close of every month. I love going in, especially not just to look at the volume, but to see the deals where there was the biggest change between the selling price today and the prior selling price. And I'll say the good news is that on balance, more properties are selling at a higher price point than at a loss. And every deal wave, and certainly we saw this year-end wave of transactions closing. Each new wave helps with price clarity and I think is fueling the optimism that we just talked about.
Well, a couple of thoughts on that. The first is I would underscore what you said about my team, really excellent about getting this data, really scouring press releases, research, and so forth to collect this every time. They do a wonderful job at this, keeping you and I and our listeners informed. It is also, I would say, very positive, very hopeful that we saw such an extraordinary number coming in December, where not only Do people take vacations and time off? It's a short month with Christmas and New Year's and all the holidays. And it's also one of those things where some things don't get reported because people don't have time to even report them in a timely manner. So we may see this number grow over the next couple days as more and more news comes out. But it's a terrific sign for the beginning of 2026. My early instinct from looking at the numbers that have been collected over the first half of January is that the number of big deals continues to surge this month. It seems like the team is turning in tons and tons of research every day on big ticket sales. So maybe we'll see a January that's even better than December. Hard to picture, but maybe we will. But my last thought on the topic is when you talk about comparable sales, I think we still see things bucketed, you might say. We're seeing nice upticks in retail. We're seeing nice upticks in certain parts of the market for industrial, for sure. That trade just never gets old. But the laggards continue to lag. Offices, we're still seeing those 60, 70, 80% discount sales, really no meaningful movement there. And on the apartment side, in some of those hot markets where we've seen an absence of rent growth, you're seeing either negligible upticks in sale price or in some cases modest declines in comparable sales. So it is in many ways still a very much a tale of winners and losers in the various subsegments.
Dianne, let's shift gears and head into our Did You Know for the week.
We just got our fourth quarter data from the LightBox RCM platform for property listings. And I like to go in and look at the average number of viewed agreements for the year across property types. So viewed agreements means a prospective buyer is coming in and looking for more information on a particular listing to see if it maybe strikes their fancy or is worth a bigger dig. And the average number of viewed agreements across all property types was up from 118 in 2024 to 157 in 2025. So I think, Manus, that speaks to more interest from prospective buyers, certainly than we saw in 2024. You can probably guess that multifamily was at the top of the pile with an average of 209. And then the last thing that I looked at was where I'm seeing the biggest increases in interest by buyers in 2025 versus the prior year. And that was in the classes of land, of multifamily. Office interest is up significantly, as well as healthcare. And in your team's data on deals that closed, I noticed in the December data, Manus, that a lot of the land deals that closed are earmarked for multifamily development projects.
I think that makes sense. I mean, multifamily, of course, is the biggest asset class in CRE, and it is normally the most stable and the most desirable. So no surprise that we would see a lot of views there. But probably also juicing the views a little bit is that and office are not terribly frothy right now. People are probably saying to themselves, this is not a terrible time to buy. Pricing has come down. Expectations for rent growth have come down. This might be the time to deploy capital. And that might be luring in more people than normal, as opposed to something like industrial, where we're at the end of the 10th year of a 10-year rally, where people are saying, I have a lot of industrial. It's run up quite a bit. Do I really want to add more supply now, or am I buying at the peak? I don't really know, but my gut tells me that some of this interest is coming from people who are saying the pricing is kind of getting right in the multifamily and office segments, and I should start to dip my toe.
Yeah, there's certainly, I think, a lot of reshuffling of interest, especially in a market as differentiated as this one is. And I think the office sector in particular attracts a lot of curious cats, just because there are so many headlines and there's so much differentiation from one deal to another, some appreciating, some dramatic discounts in office. And I think in some respects, it might just be folks kind of going in and looking at more specifics on a deal, even if they're not ready to jump in on an office transaction yet.
Somebody used this term a few weeks ago, and they talked about it in the broader CRE space. I think it was a Wall Street Journal headline, but it really applies to office. Too cheap to ignore. That if something is selling for 75% below where it did a couple of years ago, it's too cheap to at least not look at and kick the tires, especially when you consider that in some of these markets, we are starting to see decent, if not great, leasing rebounds. In New York, it's great. In San Francisco, it's decent to better than that. And for some people who can buy stuff in the discount bin and hope to release things based on an AI boom, an AI leasing boom, that's terrific, right? We saw this week that OpenAI was about to take another 250,000 square feet of space from Dropbox on a sublease basis. That's going to push their square footage in the Bay Area over 1 million square feet. So I think people are looking at this and saying, let's get in on this. OpenAI won't be the only ones consuming space in the Bay Area in the coming years.
Let's jump to the CRE stories making headlines this week, starting with retail.
Yes, it's been a while since we've talked about retail, but I have several stories here that I could run through in short order. I'll start with one surrounding MetLife. MetLife selling 2 properties recently in the large retail segment, looking to take some money off the table, apparently. This first one comes from Real Estate Business Online. MetLife selling the Chino Spectrum Town Center, selling it to Brixmor for $138 million. That turns out to be about $300 a square foot. MetLife bought the property in 2017 for $144 million. So taking a modest loss on this particular sale. They were also the seller last month of a national property, One Bellevue Place. They sold for $90 million, $251 a square foot. That's down 2% from their acquisition price a couple of years ago. So MetLife taking some money off the table. I'll run through a couple of other sales. Some of these were from late last month, but they talk about the big ticket sales wave that we saw at the end of December. First one, Scott Baltic of Commercial Property Executive. Sterling sold a San Antonio shopping center for $115 million. This property, the Park North Shopping Center, a 635,000 square foot property, $181 a square foot. Denani Private Equity Group was the buyer here. I like bringing this one up for 2 reasons. One, Texas as a non-disclosure state, they don't reveal a lot of sales prices, so we have a nice comp here in the retail space in San Antonio. I also like bringing it up because Sterling bought this property in 2016 for $81 million, so they made a nice 50% return, close to it, on this particular asset. One more that I'll throw out there, GGM Capital sold a Torrance retail center for $109 million. This comes from The Real Deal. DGM Capital selling Village Del Amo, 170,000 square foot shopping center in Torrance for $108 million. The article notes that it was the largest retail sale in the South Bay market last year, coming in at $650 a square foot.
So these are great examples, Manus, of a theme we've talked about before, which is, necessity-based retail, grocery stores, local centers are attracting more interest than others. The Sterling example in particular, I looked up the background there, and Sterling bought the property in 2016 for $81 million. They increased occupancy from 73% to 93%. So a definite value add that paid off because they sold it for $115 million. I say that not knowing how much money they put into it, but still, it sold at a higher price. I think these are examples of what's working in retail right now. The Sterling deal, that's a property that was anchored by, or is anchored by, Target. So I don't think that when you're buying a shopping center, you can go wrong because Target is a proven brand. It's going to guarantee foot traffic. And that was in San Antonio. It's not a coastal gateway, but it still attracted a private equity buyer. And I feel like investors in retail who are out there are looking for ones that are well located, that have good foot traffic, that have high occupancy rates. And all of the deals that you just mentioned certainly check all those boxes.
Retail is one of those segments that just goes to show how misunderstood a market can be by tourists in commercial real estate. If you remember, for years and years, from about 2015 to 2022, you heard the term retail apocalypse over and over and over again. And there certainly was an apocalypse in terms of hundreds of retailers going out of business, from Sports Authority to Toys R Us and hundreds in between. And plenty of mall owners saw the property value of their malls go from, let's say, 200 million down to 20 million. That was apocalyptic, but that represented such a small sliver of the market, from strip malls to high-end AAA malls to shopping centers, the type that are occupied by the Marshalls and the TJ Maxxes of the world, grocery anchored retail. Those all really overperformed over the last 5 years. And they were by far the deepest part of the narrative in retail, even though the retail triple C, triple B shopping mall got all the attention.
Agreed. And I'll make a plug here, Manus. We have an upcoming guest named Greg Katz. If you don't know him, he's a wonderful retail sector expert, also very much in the know on the technology front, and he's at Esri. So he does a really clever piece on LinkedIn about Main on Main, which takes a very nostalgic look, Manus, at retailers that did not survive an apocalypse that never really happened. But he's really fun to talk to about the various cycles that retail's gone through and what separates the winners and losers and the impact that technology has on retailer site selection. So very much looking forward to that conversation.
Greg will be joining us next week on Friday, January 23rd. So make sure to listen in. And now let's pivot to our development stories for the week. Manus, what do you have for us?
So this folds back into the term confident and liquid that we were using before. I just have one this week that I'll throw out, but I could have come out with 10. This comes from Elizabeth Cryan of The Real Deal. Yellowstone getting a $326 million construction loan for the Watson Hotel conversion. New York, as we've mentioned before, really the epicenter of hotel/office to residential conversion. Here, Yellowstone, which is led by Isaac Hera, got the loan from Barings. They will convert a property at 440 West 57th Street in Hell's Kitchen, really as far west as you can go, right near the West Side Highway in Manhattan, where they will redevelop the property. It once served as a 600-key hotel and later a migrant shelter. It's now going to be 316 apartments spread across 2 different towers. So this, again, a situation where a developer is confident enough to come in and say, I see something that's obsolete, underdeveloped, in need of an alternative use. He's confident enough to put a shovel in the ground, or in this case, raise the property to some degree, reposition it. And you see lenders here in Barings confident enough to believe that A, Yellowstone can execute on this redevelopment, and that on the back end, they will be able to be taken out with new financing after that execution takes place. So we're seeing this in spades in New York. We're starting to see it in other cities, and I think it's a great headline that has yet to really take root among the national business press about just how quickly this is happening in certain markets.
And I'm glad that you mentioned this story this week, Manus. It certainly sounds like an interesting conversion and a hotel that's worn a lot of different hats through the years. But the reason that I'm glad you mentioned it is because it reminded me that there was big news out of Albany this week. New York's Governor Hochul is rolling out her broad Let Them Build agenda. And part of that push includes a proposal to accelerate home building by streamlining environmental reviews under the State Environmental Quality Review Act. So housing in New York is a huge focus, and there's government support now to remove barriers so that practical, well-located housing projects can actually get built. And Arizona did the same thing just this week, unveiling a new housing affordability blueprint with things like tax credits and zoning reforms. So I read these headlines and it's a lot of momentum is building in housing this year. I think we'll see more, especially leading up to the midterm elections. And these types of reforms could fuel more conversion projects. And I think it's the meaningful pivot in markets that really struggle with supply constraints and regulatory complexity.
I hope you're right. On the glass half full side, obviously the Mamdani election in November was kind of foreshadowed as early as June of last year, right? So we're now in like 9 months. June of last year, he won the primary. So starting in June of last year, people started to think that might happen. And of course it did in November. So they've had 9 months to kind of absorb this. And thus far, we haven't seen any slowdown in people trying to take these on. That so far, people like Yellowstone have not said, you know what, let's tap the brakes. Let's see how the regulatory climate evolves before we pull the trigger here. And Barings, the same thing. So that's the glass half full. The glass half empty is I do think that that remains a risk, at least in the 5 boroughs of New York. We see the mayor being very, very active. He's taken on a position in a bankruptcy filing that's going on right now. He has been very active in pushing public sector ownership of these properties, sometimes not in a way that has been terribly constructive. And that remains a risk, I think, for this entire market. I'm not sure if you saw this, Dianne, but he took a developer to task for having hundreds, I guess, of violations and leaky roofs and vermin and heat that doesn't work and so forth. And of course, we don't want to see that. We know why this happens in New York because of rent control and rent caps and so forth. But ironically, the property that he took as a model for, and maybe I'm going non-PC here, the model for public ownership of properties, it turns out, had even more violations than the property that he was criticizing. And until that becomes more apparent, what the strategy is going to be for how we handle affordable housing in New York, I think it still remains a very toxic asset to buy, and that's not a good thing.
Yeah, nobody likes uncertainty. So I guess the only prediction we can have on that front is that you and I will be talking a lot more about Mondani this year as the year unfolds. Certainly a lot happening there.
Manus, we haven't covered the office segment in a few weeks. What's making headlines there?
I'll bring up 2, both of which are quite positive. The first one from Brian Bandel of the South Florida Business Journal. I call him the hardest working man in South Florida just because of the sheer number of commercial real estate stories that Brian puts out every week. It's really quite extraordinary. He notes that Citadel's Ken Griffin teamed up with Goldman Properties to buy 545 Wynn. This is a new office building in Miami, paying $180 million for this particular property. I think it comes out to about $615 a square foot, which is a real nice price for that Miami market. You don't see $600 a square foot every day in many markets at all, absent really Class A stuff in New York and San Francisco. So a really nice price tag there and a vote of confidence from Citadel's owner and from Goldman Properties in Miami. The other one here, I thought this was an interesting one, and it'll lead into our slice of life. Fortress Investment buying a manufacturing campus. So this is half manufacturing, half office near Raleigh for $225 million. The main tenant of this property, which was called Spark LS, is in Morrisville, North Carolina, and it is occupied by Pokemon. If you know Pokemon, they make trading cards, I guess, for kids, collectibles. I think maybe they have a TV show. They make little figurines. I do remember my kids were really into this at one point. There were Pokemon cards all over my TV room all the time 15 years ago. So we see this every now and then. We get this creative office / industrial being paid up by video game makers, creative types, and here a nice $225 million price paid by Fortress to acquire this Triangle Raleigh-Durham asset.
This is one of those deals where the headline kind of makes you stop and smile. I'll say that Pokemon is a pretty sore subject in our house because my son was very into them. All of those card packs, I can picture the cards perfectly with weird names like Snorlax, and each card had a picture of the character's special skill and their weakness. And the reason it's a sore subject is that my son had boxes of them organized in these notebooks with plastic pages. And we can't even talk about it anymore because in one of our moves through the years, I ditched the boxes because they were in the garage and they hadn't been touched in years. And it must have been his retirement plan because he still has not forgiven me.
Oh, that's rough.
I know.
Manus, Dianne, anything that you've collected over the years that you care to share with our audience?
Well, when I was a kid, I was the baseball card guy. and not just baseball cards, anything I could get my hands on, hockey cards, football cards. I was like your son, Dianne, boxes and boxes of boxes, all thrown out when our family moved. I'm not sure there was anything in there that was going to net me $500,000 in the secondary market. I always lamented that I got ends and ends of commons. The middle reliever for the Baltimore Orioles, never Roberto Clemente. So that was my collectible as a youth. And as an adult, I don't know, this may be thrown out at our next move as well, but tons and tons of concert posters and old newspapers with headlines of my team's winning championships that load my basement. So Allman Brothers and Bruce Springsteen and Dave Matthews, along with headlines from the New York Post of the Mets or Rangers or Giants winning titles. That may someday end up in landfill. I hope not, but every time I walk into my basement, my happy face comes on.
That's awesome. As long as they bring you joy, Manus, it's great. And sports are a great thing to collect. I have to say, I'm kind of embarrassed to share with both of you, especially you, Manus, because I feel like this will haunt me as soon as I reveal it. But when I was little, I had a very short-lived chapter where I'm embarrassed to admit that I collected Smurfs, those weird little blue figurines. And it didn't age well because now I'm so passionate about gender equality. And there was a definite patriarchy with the Smurfs. There was one female, and they gave her the name Smurfette. And it really just, as an adult, just makes me cringe to think that I once collected them.
I don't think there's anything cringeworthy about a kid collecting anything, whether it's Barbie dolls or baseball cards or American Girl dolls. I think as long as it's wholesome and makes you feel good, it's a good thing. So good for your Smurf collection. How about you, Alyssa? What was your big collectible as a kid?
The Beanie Babies, they were big. I'm hoping one day we can cash in on them. In recent years, I've tried to collect a postcard from each place I've been. I have a vision of getting a cork board and a map and pinning places I've been and tracking over the years.
I love the postcard idea. I think that's great. And it reminds me that I have 2 shoe boxes here filled with old ticket stubs of every concert and every ball game that I ever remembered to throw in the shoebox. And I'm always tempted to turn it into a table where it becomes the countertop for a coffee table. So I could always look at, oh, look at this, the Rolling Stones, or look at this, the Who.
I love that.
It sounds like we have some DIY projects coming up. Thank you to our production team at Brooding Media. Please join us every week as our LightBox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.